If you listen to the media, you'd think property prices are driven by interest rates, by immigration numbers, and whatever the Reserve Bank's going to do next month. But when you strip away the noise and look at what actually moves property values over the medium term, there's one factor that quietly dominates everything, and it's jobs. Now, not just how many jobs, but what type of jobs, where they're located, and who they attract. So welcome to this week's episode of Demographics Decoded, the show that unveils the trends shaping your future. Hi, I'm Michael Yardney, and I'm joined each week by leading demographer Simon Kuestenmacher, and together we dig beneath the data to uncover the trends that are shaping our economy, our communities, our future prosperity, and what that means for your business, your investments, and actually your future prosperity. Of course, our aim is to help you make sense of what's coming up next so you can make smarter decisions for your business, for your investments, for your life. Simon, today I'd like to unpack why employment is the real engine of property markets, why population growth is often misunderstood, and how the future of work, jobs, employment could reshape where Australia's next property winners are going to emerge.
Yeah, very good way of phrasing this. Of course, it is people that live in houses, it's people that buy properties. But in terms of how much money people have available, where they would want to settle, and how they operate on the housing market, that is much more linked to their job, to the income, or in general, more general terms, to their wealth, which is in a sense driven by property, by employment markets as well.
Well, I know you're biased being a demographer, but property commentary is obsessed with interest rates. It's been for years, and it's already been in the news continuously this year. But from a demographic and an economic perspective, why do you think jobs matter more than interest rates when we look at medium-term property growth?
Well, so the employment, the job that you have, that very much impacts your general confidence and your just the amount of money that you have available, and you make decisions based on that first, and then you take interest rates into account, if that makes sense. You first look at the thing that you have an active control over, which is what kind of job is available to me, what kind of lifestyle can I afford this way. And of course, it is the kind of jobs that then form household decisions. Do we as a couple have enough money to afford one child, two kids, three kids? And this is much more linked to the jobs. Yes, to a degree.
Well, interest rates affect short-term sentiment. People feel confident if they think they're going down and my pay packet's more secure, feel a bit less confident in the short term if interest rates go up, or there's talk about that. But labour markets reshape cities over decades. So I'd argue that property values are ultimately powered by pay packets, by the local economy. From your data, how strong is the relationship between wages growth, job security, and housing demand?
I guess the important thing is to remember that people move to a certain city because of the job. That's the whole point. Is I moved to Melbourne and Sydney as an Australian because that's where half the jobs are, more or less.
Yes.
And so that is the important reason. So I'm not saying I moved to Melbourne City because I like this more than a certain kind of regional city. Maybe I would consider the regional city if it had the same job opportunities for me, but they don't. And so I just look at the big centers, and everybody does the same thing. And therefore the availability of these jobs really pushes us into a certain market. And that then drives up the prices in this certain market even more, because we can't spread jobs evenly out across the whole city network that we have. We cluster jobs.
So we're talking about jobs, but really local economy is what drives housing markets more than some of these other factors. If the economy is doing well, more jobs and better jobs are created, more households have got stable incomes and wages growth. That means confidence rises. As you say, people upgrade their homes, buy first homes, invest or relocate. And if the demand for housing rises faster than supply, as it has been over the last couple of years, simply buyers just have to pay more, and that keeps pushing property prices up. So our research at Metropole has shown that over the medium term, labour market strength is much more influential to property values than population growth. It influences properties more than the direction of interest rates. Jobs growth is pretty important, but population growth seems to be getting many of the headlines, Simon, but it seems to be a bit of a disappointment. Why doesn't population growth always translate into capital growth?
If you look at this house that I'm in, my wife and I lived in it before we had kids. And so we then grew the Australian population by 2 kids over the last 6 years, but we didn't drive up demand for more property and therefore property prices because we just squeezed them into the same house. So
Yes.
that's the idea. So some of the population growth, the kids that we make, they do not immediately translate into more properties needed. It's the same with it's the number of households that drive the demand for property, because ultimately we don't care how many people live in the house for the supply. It's just the number of households that are real important. And of course, we have all those social structures in there as well. When we think about the shift to dual income households, then all of a sudden, if you become a dual income household, you have more access to more capital. And you can then buy a nicer thing. And you then go, well, I live in this house all the time. Why wouldn't I spend my money on this nicer house? And so as you have more people moving into dual income households, more and more people can spend more money on housing. And which was a nice to have at the beginning when the boomers first introduced women into the workforce. And you went from one household income to 1.5 household income. Then it immediately translated into it was nice. You could just afford more stuff and it felt wonderful. But now this is a sheer necessity, and it's not extra spending, it's a sheer necessity that you have. And so you really must increase the number of available jobs and the quality of the available jobs, meaning the pay package, and then you can afford a nicer house. But since all people do this kind of game, you drive up prices much more through those jobs than just through the fact that people exist and are around.
Sure. So, of course, population growth or family formation matters. Actually, as you correctly said, it's really how many families and households rather than just number of people. A region can add population that's lower income, more transient, not employed locally, meaning it won't necessarily give meaningful upward pressure on property prices. And there are other regions, and that's why it's important to look at demographics in local economy that have got higher job participation, higher wage roles. I think of knowledge industries, infrastructure pipelines, defence, health, education, resources, advanced manufacturing, all the logistics and AI. That tends to create the kind of demand that pushes up what both buyers can and are prepared to pay, but also renters, because we want renters who can afford to pay your rent. Your future income as an investor is going to be dependent upon your tenants being able to pay more rent. Of course, there's other drivers to capital growth, the supply and demand scarcity, as we've discussed before, the availability of credit and interest rates, that's important. But demographics and household formation is going to make a difference, as is infrastructure. Over the short term, sentiment makes a difference to property values, but we keep getting back to the fact that jobs growth and I guess the local economy is very important, Simon.
Exactly. And so from an investment perspective, you want to understand, if you look at a certain kind of pocket in a city where you want to invest, is like, what does the future look like for this area? So this is about storytelling. And it's about, well, who would be able to buy there and what kind of jobs would they have? Where would those jobs be? How secure are those jobs? How likely is this sector to be paying relatively high wages in the future? Because we do know that we tend to max out our spending in Australia. This is a consumer behavior as well as a economic necessity. We want to live in the nicest house possible, so we tend to fork out a quite large chunk of our income on housing. And we do this, of course, to a certain degree linked to our total amount of money that we have available. So have all of those things in the back of your mind, and it helps you to understand how much prices will rise. It is generally true that all the boring standard statements like we have an oversupply of population and undersupply of housing. So that, of course, overall drives up prices. But if you don't invest into the average Australian house, you invest into one house apartment that you buy. So you want to understand the story that this particular dwelling is going to go through over the next 10, 20 years of while you hold it.
Well, now, Melbourne's an interesting, I guess, a fascinating case study. We both live in Melbourne, which has had very strong population growth over the last years, but weaker price performance recently than the other capital cities. What went wrong in Melbourne?
Well, this is what went wrong, what went right. This always depends on the perspective. So what happened is that Melbourne's population, the new population, we threw into a cheap type of housing, which drives down the average house price. We built out Melbourne. Melbourne continues to sprawl. We keep forgetting how gigantic Melbourne is. And so a city like Sydney hits the Blue Mountains by now. So you have to build up. And building up a square meter of building up medium and high density is about twice the cost of building out, of building a square meter of housing on the outskirts of town. When you bulldoze land, you put a cheap house and land package together there. That's cheaper. And so Melbourne is adding its 100,000 people each year into a housing market that provides more of the cheaper rather than more of the expensive type of housing. And that, of course, overall drives prices down.
Well, interestingly, the local economy has also been poor, and that's been concerning people. And if they don't feel secure, if there's continual negative messages in the media, they don't make big decisions like buying a home or buying an investment. But I still see Melbourne's long-term fundamentals as being very solid. The gap between the price of Melbourne and Sydney or other capital city properties has never been as big, and eventually supply and demand is going to force the value of established properties up enough to make new development viable, Simon.
Yeah, and we must not fall into certain kind of traps of falling into a negative narrative around a city as a whole. When I came here, I've been here since 2008, always in Melbourne. And for the first maybe 6 years, probably 8, 9 years that I was here, and was always about Melbourne is the hottest place, not temperatures, like the best, coolest place in all of Australia to move to. This is the best city. There's a lot of the most livable city. All the stuff was outrageously optimistic and positive. And then we went, the lockdown capital of Australia and whatnot. And so then all of a sudden it's meant to be this hellhole. That is a naive narrative, and we must not fall for this. During the pandemic, the first 2 years of the pandemic, I read countless articles making stupid statements like, this is the end of New York City. This is outrageously dumb. This is the most famous city on the planet and always was attractive, and all of a sudden is meant to not be attractive anymore. This makes no sense whatsoever. The base level of attractiveness, the cultural clustering, the kind of general vitality that a city creates, it continues to create it. Cities do need to reinvent themselves, absolutely. Melbourne needs to rebrand itself. It needs to find its footing again. But it's not a bad city to live in by any stretch of the imagination, even though sometimes people might want to, tell this story for whatever reason. I don't buy it. If you really look at your house, your neighborhood, has it gotten worse in the last 5 or 10 years, whatever you look at? It's like, I would argue in most cases it hasn't. It's more a fear of some sort of narrative that is being spun. And I said, don't fall for these narratives. Just live your life and enjoy your
Yep.
life.
Well, sentiment lags fundamentals, and it overshoots both ways, doesn't it? During booms, people are most positive when maybe they should be a little bit more cautious, and during the downtimes, people are negative when, I think Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. So there is a hierarchy of drivers of residential property growth. The local economy, I see it as the engine, with supply, credit and demographics adding a bit like the transmission and the tyres in a car. Demographics determines who wants houses, supply determines how much friction demand encounters, and credit, the availability of credit, I guess how loud the engine can rev. Which of these drivers do you think, in nice car analogy, but which of these drivers do you think investors most commonly misunderstand?
I love the idea of credit or interest rates just really allowing the housing market to rev. I think that's hilarious. And that's exactly what it is. And you've seen this, that during the pandemic years, when economic sentiment should have been bad because, dude, we don't know if the whole thing collapses or whatever, but credit was super low. We then created all these incentives for people to upsize and go like, yeah, you know what, credit is so cheap. I have a bit of money. I might as well do this. And now some people that overspent in this low interest rate phase, they're now, feeling the brunt of their decision by paying really high interest rates now, or mortgage repayments. But yeah, that's the function of credit. I think that's quite nice. A nice way of putting it.
So it's really not interest rate, but it's the availability of credit, isn't it? But which of these drivers then, the ones I just discussed, do you think many investors misunderstand or misweigh?
Well, so there's certain things like you mentioned infrastructure. So the idea that we say, well, the availability of infrastructure. Is this alone driving people? Because we do say things like, build it and they will come. Yes, that's all true, but you still need to provide the jobs. So this is when we come back to jobs as the fundamentals, and not just any type of jobs. You need to have a job that is ultimately economically productive, not just pays a wage. So that's the argument that we relied too much in the last couple of years on public jobs to amp up job growth rather than private jobs. But that's problematic. It's problematic for technical reasons that we try to, this is how we measure GDP. A business, they sell stuff, they create value. So it's relatively easy to measure how much they added to GDP. We can't do this easily with a public employee. So what we do with GDP figures is we say, well, let's say a public employee earns $100,000. That's the wage. We take this as a shortcut to what is added to GDP, which is not true. But so you can create, technically speaking, you can create bullshit public jobs and they still amp your GDP figures up. Maybe the public employees really drive this. Maybe they create even more value for the GDP, but they might also create less value. So the more public employees you have in the system as shortcuts for economic productivity, your productivity numbers might be a bit out of whack. So I'd say don't rely too much on GDP. Just to understand how attractive this is, look where those jobs come from. Infrastructure might be overrated if it's not linked to jobs, if it's not leading to jobs. Infrastructure in the middle of nowhere is not actually providing necessarily better housing. Yeah, and of course, we talk about stuff like the economic diversity. So you want to make sure that your economy is not a one-trick pony, that you have a certain kind of depth in there. So if that's a given, that's important for investors. If you're monoculture, so to speak, could be dangerous.
Well, we've spoken about the future of employment in previous episodes of Demographics Decoded. So if you're new to this show, first of all, please take a moment and follow or subscribe, depending upon which app you're listening to this, so you get Simon and my shows and discussions each week. Well, we've talked about the sort of jobs that are going to keep driving demand and growth in the future: healthcare and aged care, education and research. There's certain industries that are going to do very well. But moving forward, Simon, what about AI? Will that reshape white-collar employment? How do you see automation where high-income jobs are located?
So the argument for a while was, if we can work all remotely, this is the remote argument. So if we work all remotely, we can spread, we can work from anywhere. Turns out that wasn't the case. We work hybrid. We still go to the office once or twice a week. So that, of course, then means that we have to stay within this 2-hour drive time radius from the CBD. So that's important. The more we shift towards away from an industrialized economy to a service economy, which is still continuing this transition, the more we remain linked to the job center, to the big CBDs. That is not going to go away. But I would argue that the vicinity to the office, meaning it bounds us to the big 5 CBDs, that even becomes more intense through AI. Counterintuitive argument. So what my thinking here is, AI will speed up the technical tasks, creating a map, coding, whatever it is, these technical tasks, writing emails, reading reports, that they can become faster through AI. That means the technical share of your job is getting smaller, and then the interpersonal, the creative, the interpersonal part of your job gets bigger. And these kind of work elements, they better take place in person. They benefit from humans being together in the same space, which in turn would bound more people to the office towers, which means it's good news for commercial real estate, but it also means from a property perspective, we still want to act like we've done before the pandemic and live relatively close to the office tower. Of course, we take into account how big is my family, how large of a dwelling do I need, but ultimately the vicinity to the office tower remains very, very important.
Well, you spend a lot of time looking at the future through the demographic lens. For people who are not familiar with what you and the demographics group do, how do you help your clients, Simon?
We try to understand who our clients are, how our clients make money, or what their purpose is, if they are an NGO, if they are government, and then we show them their own world through the demographic lens. And we go, well, through the demographic lens, what kind of weak spot might you have? What kind of challenges are you facing now or in the foreseeable future? And then we try to look for opportunities to make sure that we're not just pointing out scary stories or wonderful developments and show where you can play an active role in working with these trends.
I'll leave a link in the show notes to the demographics group so people can find out a bit more about you and see if you can help them. At Metropole, our team help our clients grow, protect, and pass on their wealth to future generations through strategic property and wealth advice. We don't sell property. We're much more than a buyer's agent. We help our clients safely outperform the markets by starting with a strategic plan and helping them implement that plan. At the end of last year, actually, we won 3 awards, Simon, from finder.com.au, including Australia's most trusted buyer's agent and best buyer's agent. But we're much more than the buyer's agent. So if you want to take advantage of this new stage of the property cycle, go to metropole.com.au. I'll leave a link in the show notes. Now, today's talk's been a lot about property. In our shows each week, we talk about demographics in the future in all sorts of areas. So again, if you haven't subscribed to the show, please do so. But I guess the lessons from today's show, Simon, are there are a number of factors that affect property values. Jobs are going to be, the local economy is going to be pretty important. So what do you think this means looking forward in the future? What sort of industries would you be looking for to help support our economy?
So I would always look at Australia not changing its main business model all that much. So that means mining will continue to be strong, agriculture will continue to be strong, even though it does this on fewer workers, tourism, and we'll have international education. These remain strong factors. Then, of course, we want to diversify the economy as much as we can. And it remains to be seen how well we can do this. I would very much put a strong point on defense. I'm absolutely certain that defense spending will escalate. That, of course, means that any kind of town that has their finger in the defense game should benefit. So this is where a Townsville, where a Cairns, and Adelaide, Cairns maybe, or no idea if anything happens in Cairns for defense. But so if there is defense, so Townsville and Adelaide would definitely benefit. Darwin would benefit to a degree. Perth, that's one. So that's a certainty, if you
These are
will.
long-term trends too, aren't they, that you're talking about?
Exactly. And we're not going to unroll this type of spending. We just know that we're going to spend more of our budget each year on defense, to manufacture stuff, to build out kind of naval bases of sorts. And that'll drive local businesses. It'll drive local property markets. So if you can be part of this, you will be doing well, because I would be utterly surprised if this would be going away, if this was to slow down.
Sure. So I guess my takeaway from today is that property markets don't move because of headlines. They move because of pay packets. So don't just ask, is demand strong, but ask, who's earning the money? How much are they earning? Where are they? And also, not just is population growing, but is it skilled, high income households that are moving there, because it's pay packets that are moving the markets. Of course, interest rates matter, population growth matters, infrastructure matters, but over the medium term, none of them work unless there's a strong and resilient local economy underneath it all. Jobs create income, income creates confidence, confidence creates competition, and that's what ultimately pushes property values up. So the mistake many investors make that I found is they're wondering how many people are moving into this area instead of who are those people? What are they earning? How secure is their employment really? And as we've discussed, not all jobs are created equal. So rather than asking whether interest rates are about to rise or fall, a better question as an investor is to ask, where are the high quality jobs being created? Which locations are going to be building their economies? Think about what's going to happen over the next 5-10 years, not what's going to happen over the next 5 or 10 months. Because if you follow the jobs, the property market usually follows too. Simon, I look forward to catching up with you next week, because I want to discuss an article that you wrote a short while ago in the New Daily about the concept of dying with zero, spending all your money. It's something that when I reread hit me again. So I look forward to talking about that when we catch up next week.
Wonderful. Looking forward to it.
This Demographics Decoded podcast has been brought to you by Metropole Property Strategists. We provide a complete range of services to help our clients safely create intergenerational wealth through strategic property and wealth advice. If you're looking to buy an investment property or your next home, why not have a discovery chat with one of our wealth strategists? Just go to metropole.com.au and explore your options. You'll find we're much more than just another buyer's agent. We provide a complete range of services, including property advisory, wealth advisory, home buying, buyer's agency, property management, renovations, and development management services. The team at Metropole will help you with frameworks that I've fine-tuned over 5 decades and we've been helping clients with for well over 25 years. We're big enough to tip the scales in your favour, but still small enough to care. In between these Demographics Decoded shows, you can follow me on social media, and I suggest you also follow Simon Kuestenmacher. You'll find him regularly posting on all social media platforms. And thanks for spending the last little while with Simon and me. I hope you got some benefit from the show. And if you did, and you know somebody who may also benefit, please tell them about Demographics Decoded. There's a share button on every podcast app. I hope you're going to be doing them a favour, and you're definitely going to be doing us a favour, helping us in our quest to make as many people as possible aware of the demographic changes that are going to be shaping their future. And of course, if you don't currently subscribe, we'd love you to. And of course, any of the information that we've been sharing with you is general information because we don't know your specific circumstances.